Welcome to this presentation on basic investment considerations. We're going to go over quite a few topics, so let's get started. This is what you need to know before you start becoming an investor. You need to know the difference between risk and return. Risk is the level at which you're comfortable risking your money at. You need to make sure that you're going to receive an acceptable level of compensation for your investments, and your rate of return needs to be reflected on how much risk you're taking on to make sure that it will pay off in the end. All financial assets are risky. You need to consider carefully the different types that exist. Investors demand a higher return to compensate for their higher risk. Therefore, the riskier the investment, the higher the rate of return or percent back every year you should receive on that investment. Riskier assets offer higher returns to attract investors. You need to make sure that you carefully consider your options before you dive into something that's extremely risky. And then you need to ask yourself this question: what level of risk can you tolerate? Younger investors can tolerate high levels of risk because they have time to adjust and recuperate any losses. Those that are older, approaching retirement age, need to consider safe investments. Otherwise, they could lose their entire life savings and not have a fun retirement. What are the investment objectives? Well, you need to consider your own circumstances. What are some of the personal investment goals that you have? Knowledge of your own needs is important in making these decisions. So if you're trying to save enough money for a down payment on a house, then you've got to create some kind of legitimate plan to save that money month to month in a secure environment so that your down payment will be there when you expect it to. Put yourself on a 10-year plan and see how much money you can accumulate over the next 10-year period in order to solve that problem. If you needed $100,000 over the next 10 years, well, obviously you need to save $10,000 every year to make that happen. How are you going to do that? Well, you've got to be very disciplined and refer back to what we were talking about with the rule of 30% and apply that to your investment plan. Simplicity. You need to stay with what you know. Be very careful and do very close research before you decide to pull the trigger on any investment. Knowing a few basic fundamentals means that you'll be making better choices, so stay informed. People build wealth with two principles. The key is you need to invest regularly, not just some of the time, but every month. And you also need to avoid investments that are too good to be true, because they usually are. Consistency is key in any investment plan. Successful investors invest consistently over long periods of time, and they're very, very disciplined, and this day and age you can make it automatically come out of your accounts at the beginning of every month. The amount is not as important as investing on a regular basis. Save what you can afford. Remember that for retirement savings, you should be saving 10% of every paycheck that you get. Therefore, if you want to accumulate that at the end of the month, For every $1,000 you make, that means you need to save $100 to your retirement accounts. Here's a table of some of the most basic savings instruments. Now, this is not a comprehensive list, but a general category list of different things people can choose from. So, as I go over this, I'll highlight a few things for you to make sure we key in on the most important ones. Now, everybody has a savings account and checking account, and this is where you'd probably be putting your funds. So that area, let's go back. I can't see it. Anyway, this savings account is going to be critical to making sure that you have money when you need it. Anything in that account has already been taxed, and therefore what you see is what you get. You're going to typically get a very low rate of return on this type of a account. You need to make sure that you find something with a better rate of return if you plan on making any kind of money at a bank. Secondly, let's go for money market deposit accounts. With a money market deposit account, these type of accounts have a much higher rate of return because the amount of money in the account, the minimum balance, is extremely high. For most money market accounts, you have to start at $5,000 or higher in order to receive those benefits. It just operates like a high balance savings account. However, certificates of deposit are critical to understand. This is a great place to keep your emergency fund, and you can receive a higher rate of return even with a low balance in the account. So consider using that and lock your money away for a typical term of, say, 6 months. The only downside is that you lock your money away for that entire term. If it's 6 months, at the end of that 6-month period, you can decide what you want to do with your money. You have 1 week to decide, and it will roll over into a new 6-month term after that week expires if you decide not to contact the bank. Otherwise, you can withdraw your money and put it back into a regular checking or savings account and decide what to do with it after. Anyway, one of the best places to get started in investing is to look at the corporate stock market, and we'll talk more about that in another video. U.S. savings bonds are also a very stable place to invest. Typically, this is a very old-fashioned way of dealing with things, but U.S. savings bonds have a very consistent rate of return, and the maturity date is very stable. Think of it as something that your grandmother might give you on your birthday, and after, say, 10 years, it will mature and be the face value of whatever the bond is. So if it's a $50 savings bond, your grandmother probably purchased it for around $25 10 years before, and at the end of its maturity, it's worth the face value, and you can cash that in for $50. Anyway, moving on here, the areas in green are definitely places that you need to take a close look at. If I were you, I would closely watch what's happening with the job market and who offers pension funds, because these are some of the most stable retirement funds that you can afford to find. Go ahead and count on the pension funds being there when you are ready to retire. Most of the time, they are more stable than what we can find anywhere else in an investment portfolio. I highly recommend that you try and find a job that's going to offer you a pension. There are government jobs like teaching positions, but there are also corporate pensions available for the private sector. Government securities are usually high balance treasury bills that start at $10,000 a piece, and this happens to be the same treasury bill that the mortgage industry uses to set their interest rates for home mortgage loans. So keep a close watch on what the 10-year treasury note is doing. It is a really safe investment, and if you play your cards right, you can make a lot of money on investing in government securities, which are also known as government bonds. Mutual funds are by far the biggest recommended item on this list for you to consider. A high rate of return can mean that you're going to make anywhere between 5% on the low end to over 20% annually if the mutual fund is performing well. What is a mutual fund? Long story short, it's a bucket of stocks, and you can make a ton of money over a long period of time if you play your cards right. So closely consider those. Please stay away from life insurance reserves. They are nothing you want to deal with. Only stick to term life insurance. An insurance salesman will try to sell you on this product like a umbrella policy or a whole life policy, and try and attach it to mutual funds, and long story short, you're not the one making the money, the insurance company is, so stay away from those. Corporate bonds are a good place to find a solid investment, especially if they are a top 500 company, so look at that as well. Don't forget about the difference between liquidity, safety, and rate of return. All of these things come into play. The more liquid something is, the higher chance you can get your hands on your cash that you invested, versus a low liquid rate where CDs, etc., are very difficult to get your cash back because things are tied up in that investment, and it could take a number of days before you could actually see the return on the investment.